guys know, a lot of, well, I don't want to say a lot of, some of the content on this channel is finance based. I am a finance and accounting double major in college. That's what I did before I started doing YouTube full time. But I do want to preface this video with the fact that I am not a licensed professional. This is not financial advice. All of those disclaimers, but I wanted to share with you guys my new investment strategy that I will be implementing after we buy the house, which, those of you that don't know, we have a set closing date of May 15th. So a little bit less than a month away now. We are going to be, oh man, we're going to be in the best house ever. It's going to be so quiet. We're going to have a lot more privacy there. It's going to be just so much better than what you guys have gotten out of this channel. Not only is my life going to be better, it's gonna bleed into the content, and I'm really excited about that. Now, that being said, if you're new to the channel, hit that subscribe button. If you just like the sound of my voice, if you're just an ASMR fan and you like the sounds that you're hearing, you like the relaxing whisper tones that you're getting out of this video, then hit that subscribe button. And if you're a returning subscriber, I appreciate you. Let's drop a like on this video before you sit back, relax, and enjoy. Alright, here we are on Thinkorswim's web portal. Now, I am on the web portal because I do not know why, but it will not let me get on the desktop version of Thinkorswim on my gaming computer. I can only do it on my streaming computer, and therefore I have to do it this way. Now, I do not really like the web portal. It's a lot different. I don't know why they make it so much different than the desktop portal. All of my investments, though, are through Charles Schwab. They have this Thinkorswim platform, and it's great. It's great. The desktop is much better, but even this, I can tell it's very solid. Now, up here in the top left-hand corner, you will see my account value, and this is actually down over the last couple of days, $272,558. And before anybody says anything, if you're new here and you're wondering how I got all this money, I was kind of lucky. I bought my original house back in 2016. I bought a 3-bedroom, actually it was a 3-bedroom, 3-bath, 3.5 bath townhouse for $219,000 back in like 2017, I believe, 2018, and I sold it about 2 years ago for $375,000. So that was about, I can't remember how much I owed left on it, but I think I profited around $200,000, just under $200,000, maybe like $175,000. And then, of course, I had a lot of savings at the time, even before I sold the house, and I saved a lot of money when I was working full time. So that's kind of where this money came from. Now, this money is not liquid. This money is not something that I touch. This is not my savings account. This is money that I have, put aside and kind of keep in this account so that I don't do egregious things and spend my money on stuff that I don't need to be spending it on. Now, that being said, before today, I was under the impression, well, not under the impression, but I was going about my investments with a dividend style investment, a dividend portfolio. You'll notice, well, maybe not so much now, but before in my last video, I had a lot of dividend paying stocks, and I showed you guys my portfolio. I showed you guys my spreadsheet showing how much money I made in dividends every month and dividends every quarter. And actually, I can go ahead and show you guys that. Well, I can show you guys that now. Here we go. This was the, I haven't updated this in a while. You can tell by the payment dates over here, but This was basically my portfolio for a long time, and as you can tell, I was making about $276 in dividends a month, and then 800. So you times that by 3, that's about $830 a quarter, which is great. I love passive income, and that was kind of my goal with investing in dividend-paying stocks. I went with safe dividend payers, ETFs, Walmart, companies like Pfizer, Pepsi, Microsoft, JP Morgan, Johnson & Johnson, Goldman Sachs, Caterpillar, Chevron, Apple. That was my dividend portfolio for the most part. Now, as great as it is to get these dividend payments every quarter, $830 of dividends just for holding these stocks. Upon learning of this new strategy of covered calls, I have decided to shift my attention over to a more growth stock portfolio. Now, as you can see, let's kind of talk about what is a covered call. One of the biggest companies, or one of the most, a company that I'm invested in the most of, like one singular company, is GCT, or Giga Cloud Technology. We can click on it here, and you'll see the graph. I believe this is the weekly graph. Here's the daily graph here, and you can see where I've kind of plotted some things back in December. I don't use Thinkorswim to draw anything anymore. I use tradingview.com. I really like that website, but as you can see, it's got a high of $45.18 and a low of about $6.66. Wow. All right. Where's my cost average? I don't even know. Where do I see? Okay, so here's my trading price. I bought in at $29.29 and around $14,750 worth of stock. That's essentially what it cost me. And now it is worth $34.95 with a total open, close, or profit loss since opening this position of $2,800. Now, this company does not pay any dividends, but that does not mean we cannot get passive income out of this company. So basically what a covered call is you're agreeing to sell your shares for X amount of dollars, and when you agree to that, you are paid a premium, and that premium can be worth $10 to $1,000, depending on how likely it is that the stock price that you're agreeing to sell at and the date that you're agreeing to sell at actually happens. And obviously no one's going to pay a lot of money for a call that is like $200 call on a $30 stock. There's no money to be made there. So we can go in here and I will show you guys where is positions. Let's see. I just saw it. Here we go. Option trade. So we do not want to. No. Covered stock option trade. Okay, so how do we get to? I just saw it a second ago. Option chain. Here we go. So if we go and look at the option chain, July 19th, 2024. Again, it is currently April 17th. So this is about 3 months from now, 3 months time. We can come down here and we can see there are $60 contracts, $60 call contracts that we can sell currently for $2.15 a contract. Now, one contract is worth 100 shares, so each contract that you're selling is essentially worth $215. Now, I currently own 500 shares of Giga Cloud Technology, which means I could sell up to 5 contracts and be completely covered. Now, again, what I'm essentially agreeing to is on July 19th, or anytime before July 19th, I'm agreeing agreeing to sell my 500 shares of GigaCloud technology at $60 a share, and I'm going to be paid $215 per contract. So times that by 5, that's over $1,000 that I would make today by selling these contracts. Now, we saw that my cost average is $29.29. So if I'm selling at $60 a share on July 19th, I'm making 100% profit on that trade, on top of the extra $1,000 that I made from selling this contract. Now, unfortunately, if the stock goes to $100 a share, I have to sell at $60, which would be kind of a big bummer. But at the end of the day, my $14,750, where is it at? My $14,749.96 would now be worth $30,000 plus the $1,000 that I made from selling the calls. Now I have $31,000. I have just made $16,000 in 3 months. So when you put it that way, that it just seems like a no-brainer. Now, I've done a lot of research and I've done a lot of thought process into the downsides of this strategy. Now, obviously, the one downside is what you just heard. If the stock was to go to $100 a share, I would have to sell at $60 a share, and thus I would be forfeiting $40 a share per share, and that would kind of stink. If I hadn't sold this contract, then instead of selling for $60 a share, I could sell at $100 a share, and I would make, $30,000 instead of $15,000 or $16,000 or whatever it would be. So, with that knowledge, I started to build a little bit of a portfolio, or like a strategy, a nice little balance of what I should own or what I could own. What stocks do I like that also pay nice, healthy premiums? And that's what brings us to this spreadsheet here. So, I don't know why I labeled this present and future goal. This isn't really the present. This is what it's going to be. This will be roughly what my portfolio looks like after I buy this house, after all the money is withdrawn. I'm going to have roughly $200,000 left over to still invest, and I'm going to restructure my portfolio into this right here. I already have 500 shares of GigaCloud Technologies, and again, I have not updated this since this morning, so these prices could be different. 500 shares of GigaCloud Technologies, 200 shares of Uber, 100 shares of Google, 100 shares of SPY, which is the S&P 500 ETF, QQQ, 100 shares, Microsoft only 20 shares, Tesla 100 shares, Apple 100 shares, Snowflake 100 shares, and MGNI 1100 shares, bringing a total of $205,371.40 of liquidity. And that was, again, as of this morning. This could be less, this could be more come Friday, come closing. But this right here, these goals, these quantities of shares is the goal for me. This would imply that I could sell 5 contracts of GigaCloud Technologies at a time. I could sell 2 contracts of Uber at a time, and then I could sell 1 contract for Google, SPY, QQQ, Tesla, Apple, and Snowflake at a time. Now, as of this morning, I went and looked at various strike prices and various premiums that I thought were essentially worth the risk, or worth selling a contract for. And this is kind of what I came across. I had July strike price of $60 for GCT, which is what I showed then have $30,000 worth of equity plus the premium, $31,050. So thus my, whatever it was, $14,000 investment, $14,975, is now worth $31,050. We can move on to Uber. Uber, as of this morning, was $71.40. I picked the July strike date of $85. The premium was $1.88, so $188 per contract. That would be 2 contracts. That would make $376 at the time of the sale. The implied equity of $85 a share at 200 shares would be $17,000. Equity plus premium would be $17,376, and I did this for all of my companies. Google, Spy would be a pretty hefty one. I'm only gonna own 100 shares of Spy and QQQ because they're so expensive. As you can see, that's gonna be like half of my portfolio will be the 100 shares of Spy and QQQ, and the good thing about Spy and QQQ is they also still pay dividends, so I would still be making dividend payments every quarter. Same with Microsoft, same with Apple. So we can keep going. QQQ, $470 strike price. It was $426 this morning. I believe it's actually lower than that now. We could sell that for $366. And again, so you can see all of these strike price and premiums vary from stock to stock. But at the end of the day, if all of my stocks, if every single one of the contracts that I sold were executed, I would be left over in 3 months' time. I would have $247,000 and $247,387.40 off of a $205,000 win. Sorry, not off of an investment, because assuming this was my cost basis, $205,371, I would have made, what, $42,000 in a matter of 3 months. Yeah, I think I'm cool with that. Now, granted, I would be forced to sell all of these shares, and say if Cloud Technologies went to $200 a share, well, I would have sold $60 at $60, and I wouldn't be able to buy back at such a low price. I would have to buy back. I could buy back my shares, but it would be less than 500 shares if I had, $60 or 60. If it went to $80, then I would only be able to buy like 400 shares or 400 and some change or whatever. So I would have a diluted position in the stock. That is another downside. But essentially what this is a way to get passive income out of growth stocks and kind of limit your downside a little bit. Say the stock stays relatively flat. Well, now you have, I believe this was, hold on a second. I need to redo this. The sum of these right there, and yes, yeah, $3,039 would be the premium that I would make in 3 months' time if none of my calls were executed, if none of my calls were called on. I guess it would be executed. If nobody executed any of the calls that I sold, then I would just pocket that $3,039, and I would turn around and do it again for like some October calls and potentially make another $3,000 without having to sell anything. So if we go back and look at how much money I was making a month and a quarter, I would be making more money a month doing this strategy than I did a quarter with the dividend paying stocks. And again, when you invest in dividend paying stocks, you don't run the risk of having to sell your stocks. You kind of just get paid for holding the stocks. So there's still, there's obviously still a this is still a great strategy. However, this money, this account of mine is not meant to be this like giant investment account. This is meant to be like kind of a way for me to just hold my money and have it work for me without having to, without it just sitting in my savings account. I do have a retirement account, which is not even included in any of this. It has significantly less in it, but it still exists. So yeah, we can go back and look at what the price of, let's see, let's go to the options chain here. Let's go to October and say in October, the stock was still roughly around the same that it is now, or maybe it went to like $45 a share instead of, the current price of $35 a share. So these would obviously fluctuate, but $45 is very close to $60 in July. Ideally, they would probably offer like a $70 strike price and a $75 strike price. Probably 60, 65, 70, 75. If the stock was, around $50 a share, they're going to have to start offering higher premium or higher strike price options for us to sell. But the idea is you sell contracts, you pocket the premium, and hope that the stock goes up, but doesn't go up higher than your contract price, if that makes sense. Because if that happens, boom, you've made money on your stocks that you've been holding. You get to pocket the premium that you sold, that you collected from selling the contract, and then you can turn around and do it again the next quarter. There's no downside to this strategy. Again, you're limiting your upside, but as far as a downside to the strategy, there is none. At least there's none that you already assume from investing in the first place. Let's say I just wanted to do this, the strategy or this new portfolio. This is what I wanted to invest my $205,000 in. All of these companies could go to zero. Well, I mean, QQQ and SPY are ETFs, so they wouldn't go to zero. They would be like a collection of the top, whatever they're managed. So those are kind of safe, but Uber could go bankrupt. I don't see it happening. I really like Uber, but Uber could go bankrupt. They could start hemorrhaging cash. They could be downgraded, and all of a sudden now they're worth $20 a share. And I can't really do this strategy anymore with Uber because I have a $71 premium or a $71 average cost. I'm not gonna agree to sell my shares for less than $71 because then I would incur a loss on the stock. Ideally, you want everything that you're investing in to go up over time, and then you can continue to reap the benefits. But you're already assuming that risk when you invest into a company. Anyways, I'm already assuming $14,280 when I invest 200 shares. When I buy 200 shares of Uber, I'm already taking on that risk. So why not just make a little bit of passive income while you have that risk? There's no downside. Even if I was only able to do this one time, say in 3 months, all of these companies were worth well under what I bought them for, and I couldn't do it again. I still have a ton of equity in a bunch of great companies that I like. Plus, I now have $3,039 that I can maybe buy some more of different. I can buy down the average on some of these, and I can continue to do the strategy on one or two of them while the other ones recover from their losses. Because if you think like me, which is long term, highly, 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 highly doubt that in 5 years from now, stocks won't be worth well more than they are right now. I highly doubt that in 5 years, if you invest in the long term, you never lose. You never lose. Historically, no one that has invested long term has ever lost, historically. And I've kind of learned that over time. So I don't know, this is a little bit of a hybrid between short-term and long-term plays, but I can get behind it. I really like this idea. This is essentially a way to get passive income, dividend income. It's not technically dividend income, but passive income out of growth stocks. And that is like the best of both worlds, in my opinion. So, I hope you enjoyed this video. I know I probably did a really bad job of explaining. If you guys have any comments or questions, you feel free to leave them in the comment section. I will answer all of them to the best of my ability. If there's something that I'm not thinking of, by all means, let me know in the comments. If this is a really dumb idea, let me know in the comments. I've done a lot of thought into this strategy, and it makes sense. I've yet to implement it, so there's still some time for me to maybe back out, but it's wild to me that this is offered. It gets even crazier when you start to like look at the numbers. Like if I was to just go YOLO and throw $200,000 into QQQ, we could go and look at that. Now I would never do this. Maybe I could do 100,000 into SPY and 100,000 into QQQ or something like that. If I was to throw all of my money into one stock, it would have to be an ETF. But we can go and look at QQQ. Let's do July 19th, and it is worth $430 right now. What was the QQ? 470. So 427 to 470. We'll say 475 just because that's an even number. So 427 to 475. That's almost a $50 increase. More. 475. There we go. I'm going to take my calculator on my phone because I don't want to go through my files and try and find the calculator, and I don't want to mess up the camera here, but $200,000 divided by $427 a share, I would be able to buy 468 shares of QQQ. Now, 468 times 475 is $222,482. Plus, I would make $2.77 per contract, which is actually, so it would be $277 per contract. So 277 times 4 is roughly $1,000, a little bit over $1,000, $1,100. So you add $1,100 to that, and now my $200,000 is worth $223,582 in 3 months. It's actually less than my proposed plan, but that is because this is a little bit riskier. This is, individual companies. GCT is like a small cap company. Uber is, relatively still new tech. These are newish companies. Obviously, Google, Microsoft, Apple, those are pretty safe companies, pretty safe bets. But like Snowflake, MGI, stuff like that, is very speculative. And so when you have speculative stocks, they can be more volatile, and you can make more on the premiums, but it's just not as safe. So you're probably gonna make less, or you're gonna make more on the premiums, but than you would if you sold like QQQ premiums, if that makes sense. Anyways, I've gone on too long. I hope this makes sense. I didn't write a script for this video. video. Obviously, I've been rambling. I don't really write scripts for any of my videos, but I didn't really have like a thought process on how I was going to convey this. I hope I did a good job. I feel like I did a really bad job, but let me know in the comments if any of you guys do this strategy. What